Hello, everyone. Welcome to today's webinar. Happy to have everyone join us here. Please type yes, make sure everyone can hear me okay. Great, thank you. We're happy to have Russell Rhodes present here today. The topic is option trading around earnings announcements on Lightspeed Trader. We try to provide a lot of educational topics and different points of view and different research and analytics here for you. So give you some different ways to approach your trading and investing. Before we get started, we just have to do a quick disclaimer. So just bear with me here. This presentation is for informational purposes only. Nothing construed here today would be considered investment advice or recommendation to buy, hold, or sell any security. There we go. Sorry about that. The security derivative and futures trading involves substantial risk of loss, is not suitable for all investors. Each investor must consider whether this is a suitable investment, since you may lose all or more of your initial investment. Past performance is not indicative of future results. Lightspeed is a division of Lion Brokerage LLC. Lion Brokerage LLC is not affiliated with these third-party market commentators, educational service providers. Data, information, and material content are provided for informational, educational purposes only. This content neither is nor should be construed as an offer, solicitation, recommendation to buy or sell any securities or contracts. All investment decisions should be made by the solely based by the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Okay, thank you very much. Everyone here, just for more information on a demo of a trading platform or open an account with Lightspeed, feel free to contact us. My name is Rob Libson. You can email me at rlibson@Lion Brokerage. That's RLIVSON @lionbrokerage.com. Here we have today, we're very happy to have Russell Rhodes. Russell's career spans over 25 years, includes positions with several buy-side firms. Russell's authored several books on the financial markets, has been widely quoted in the financial press. He's a clinical instructor at Loyola University in Chicago, double graduate at University of Memphis with a BBA and MS in finance, also received master's certificate in financial engineering from Illinois Institute of Technology in 2003. He's currently pursuing PhD from Oklahoma State University, expected to complete his degree requirements in 2020. So we're very happy to have Russell here. I'm going to turn over the presentation to him. He's going to start the share his screen, and we will get started. Feel free to put some questions in as we go. If they apply, we'll certainly address them. If not, we can always get to them at the end. So I just shifted over to Russell, and Russell, please, here we go. Thank you.
All right, let me know if I'm if you're seeing what I'm hoping that you're supposed to see, and I appreciate the introduction as well. It's my first time to do something with Lightspeed. I'm very, known about the firm for a long time. I've got some good friends that work over there, and I was given the opportunity to come and talk about one of my favorite topics. But there are a few that I really like, but as far as individual stock options go, I'm a big fan of taking a look at how things act around earnings, and before I jump right in here about earnings announcements, because we timed this for when the week before earnings season kicks off for the first quarter earnings season. Needless to say, this is probably going to be a little bit different than most of the earnings seasons that we are used to. However, I am seeing where you're seeing a bump in implied volatility for the options that expire right after earnings announcements for some of the big names that everybody likes to trade. So, we'll see how this earnings season goes. One of the things that I think everybody should keep in mind right now, and something that kind of hit me as I was thinking about this webcast, when we get within a couple of weeks of an earnings announcement, companies they go into a quiet period. So, we're not getting a whole lot of information out of companies right now as far as how the coronavirus has been impacting them. We were hearing from companies 2 or 3 weeks ago that were giving us a little bit of guidance, but the next big, the next big slew of information as to how this is affecting business in the U.S. Is going to kick off pretty much next week after we get the long weekend. So we are going to experience definitely a different type of earnings season because there's going to be a lot more information coming out. It will be interesting to see how the options, how they basically are discounting what kind of move we're going to expect out of earnings. And as I go along, I'll show how the option contracts often will take this into account. I'm going to talk about what you're going to be looking for around option earnings, and then we're going to just do some trading examples around some names that people usually like to some of the more popular names that people like to trade. We get earnings announcements 4 times a year. Generally, we get a larger than average stock price change the day after earnings. If a company reports in the morning, then that is the day of earnings. And I've noticed in the past that, because I've been watching earnings for several years, that each stock really does tend to have its own unique price behavior with respect to how they react to earnings, and they kind of have a historical mean that they put in and oscillate around. And the option market does a really, really good job of anticipating what we're going to see as far as the price reaction to earnings. In fact, just sticking with that before I get into the trades, I actually, a couple of years ago, I took a look at the 50 most actively traded stock option series and basically looked at putting on a straddle or a strangle, depending on where the stock was relative to the strike prices, putting on a long one based on the offer prices, selling one based on the bid prices, and then exiting the trade the next day. And what ended up happening was you had an approach that lost a little bit of money if you bought the straddles or strangles, or lost a little bit of money if you consistently sold the straddles or strangles. And the losses were very, very close to the bid-ask spreads when you added all of them up, which I felt like was a really good indication that the option market does a really good job with respect to anticipating what kind of price changes we're going to get out of an earnings announcement. So just a quick chart, and pretty much what you need to see is appearing on this chart. I pulled this off of the Lightspeed platform, and it's basically just showing what happens to Facebook's 30-day implied volatility right after they report their earnings. And we get what we in the business like to refer to as we get a volatility crush. We've got somewhat elevated implied volatility, and then boom, it goes down. And then when we start to get within a few weeks to earnings, we actually will start to see that implied volatility start to work its way back up. And this is the sort of price action I'm seeing in options going into earnings. I was surprised to see that. I thought that this coming earnings season really was going to be something that people were not going to pay an awful lot of attention to, but the options are starting to act like we're bracing for large individual stock moves in the next 2 to 3 weeks. The pieces of information that people really care about, what's been the biggest move, what's been the biggest loss, the average move, and when I have ABS, that is actually the absolute value of the average move. And if you're thinking about, trading a straddle or a strangle, you want to look at what are those things pricing in relative to historical price moves. I wouldn't be surprised in this higher risk environment if we see, as we get closer to earnings, if we actually see the straddles overpricing relative to history And it'll be, this will definitely be an interesting earnings season, to say the least. And then I always like to pay a lot of attention to the last quarterly price reaction. And I'll expand on that a little bit more, but traders really do have short memories. And it seems like if the previous quarter was some sort of anomaly, and when I say anomaly, either a much smaller than average move or a much larger than average move, that sometimes it does show up in the option pricing, that maybe the options will be a little bit underpriced or overpriced. History is generally 8 or 12 quarters. On this, in this presentation, I'm actually going to show I'm going to show an 8-quarter history, really just because it'll show up better graphically than than we would see with a 12-quarter graphics. But it's typically the last 8 or 12 quarters. When you hear people on the business networks talking about earnings, they often talk about what's happened over the last 2 or 3 years as well. So this is a diagram that's showing Apple and going into the last earnings season. And a couple of the earnings reactions are cut off on the right side. But what we've got here is the blue lines actually show the absolute value of the average moves over the last, really pretty much the last 8 quarters or last 2 years. And the third quarter of 2019, the fourth quarter, or in the fourth quarter of 2019, we actually had slightly smaller than average moves out of Apple. Actually had just 2% moves to the upside for the couple that aren't making it on here. So knowing this information, knowing that the average moves around 4.7% and that we've had smaller than average moves, I just went looking for, maybe somebody that was and what I did at this point was I went back and looked at the block trading activity the afternoon before Apple reports their earnings. So in this case, I'll be showing you a trade that happened on the afternoon of January 28th with options that expired on, I believe, Friday, January 31st. And this is what the trade actually was. And unfortunately, my prices are a little bit off to the side, but the net credit that was taken in on this trade shows up at the bottom. Basically, just before the close, the afternoon before they reported earnings, there was somebody came in and sold the 317.5 calls and the 317.5 puts, basically sold a straddle and took in $15.15. And what that ends up coming down to is that ends up being a trade that has a break even to the upside and to the downside slightly greater than the average move. It's just interesting that this trade matched up pretty well with what the average price move was out of Apple over the last, again, the previous 8 quarters. And here's my payoff diagram. I'm actually going to try one thing here. There we go. I'm just going to show the slides like this. They just seem to look a little bit better this way. So, so right here, we've got the payoff diagram with the break even to the downside of at 302.35 and the break even to the upside at 332.65. And what this ends up, what we end up having here is a move. As long as the stock doesn't move outside of the average range, we will actually, we'll actually have a trade that turns out to be a profit here. And moving forward to the next slide, one of the cool things on the system that one of the systems that Lightspeed offers is they actually have a page that shows the stock price action just before and just after an earnings announcement. And in this case here, the E is covering what they did on what the stock did on the 29th, and then the 30th and the 31st, and the stock actually fell within the range of profitability. It actually finished up around pretty darn close to 317 or so upon expiration. So this was actually a pretty good trade. You would have had to hold it all the way through the next 3 trading days, but it actually did turn out fairly well relative to where the stock had traded history-wise, and what trade had been put on. So Apple is by far one of the, it actually is the #1 stock as far as option trading goes. Another one that's awfully popular, and another one that I know is typically is people like to trade around earnings, is Facebook. And this was Facebook actually reported the same week. In fact, Apple and Facebook report the same week toward the end of April as well. And I'm already seeing the weeklies that expire right after, or I think the first day of May maybe, but right after both those companies reporting, starting to discount some sort of larger move. Now, for this slide here, I'm gonna make it a little bit bigger so we can see the chart. Again, this is the last 8 quarters going into the last quarter's earnings, and they were reporting on the 29th after the close. Notice that the average moves around, it's actually 6.9% to the upside or to the downside. But the previous 2 quarters, we actually had pretty small price changes out of Facebook. And Facebook is one of those when we've had an outlier move, and notice that there was an earlier outlier move for the second quarter of 2018 that I'm pointing at right now. It's popping up. I do recall the options being very expensive relative to the company's price reaction history, and then we got a smaller than average move the following quarter. In this case, the options appeared pretty cheap, and typically, one way to go about trading or making a directional bet on earnings is really just to buy a single option. I know this is not a very exciting trade, but it's a trade that makes an awful lot of sense based on an outlook. Maybe you've got a bearish outlook on Facebook, but also buying the January 31st 217.5 put for 288, you actually end up having a break even to the downside that is much less than the average move. In fact, pulling up the payoff diagram here, the break even on this one was 214.61 to the downside, which actually was only 4.22%. And if you got just an average move and you got the direction correct, you're looking at a trade that costs you 288, but ends up with an option that's kind of a double, basically going up to about actually 217. Looking at an option that's probably worth about $6-7 at that point for something that costs 288. But it again, starting out with in this case a bearish outlook, and then maybe using history as a guide will help you pick the best option or the best alternative with respect to what you're thinking about, as far as your option trade goes. I did find another one that it's going to be a little bit critical of with respect to around Facebook. And when the stock was at 223.37, somebody put on a put spread where they bought the 215 put for 251 and they sold the 205 put for 70 cents. Now the average move would get us to 208.38, and in this case, I'll pull the payoff diagram up once again. In this case, the average move would have taken us to 207.85, and this is based on a slightly different stock price when this trade was put on. The thing that with an average move to the downside, something that I would have explored if this had been me was, instead of selling the 205 put, at this point the strike prices they vary by they move in increments of $2.50. Well, if the average move gets you to 207.85, instead of selling the 205, maybe think about, in this case, and I know Monday morning quarterbacking is real easy, but in this case, maybe selling the 207.50. And I believe the 207.50 put option, if I recall correctly, was could have been sold at maybe $1.05 or $1.10, something along those lines. It would have reduced the cost of the trade by 40 cents and increased the potential profitability up here. You always have to think what happens when things go wrong, and when things go wrong, especially on an earnings trade with options, you're generally, especially if you get a move in the direction that is against you, combined with a volatility crush like we saw in that early chart that I showed from Lightspeed, you basically are going to be looking at a loss equal to what the cost of the trade was. So in this case, I think I would have given some consideration to maybe looking at the 207.5 put. And again, just armed with the information that I like to look at when you're thinking about doing a trade. And I fully admit that it's real easy to look after the fact at the trade as opposed to real time. You can see that the stock reported and gapped down, and actually gapped down by a couple of days. It was actually down around 202, which was better for the person that purchased the put as opposed to somebody that put on or initiated the bear put spread. But just with those pieces of information in hand, maybe considering selling the 207.5 put as opposed to selling the 205 put may have been something that you would want to give some consideration to. So, and then one final stock, one that for years I used to enjoy trading an awful lot. In fact, I'm old enough, and some other people here may remember, there was a time that I believe Micron would actually report during the trading day. There were 2 or 3 stocks companies that would report their earnings, and I'm talking about 20 plus years ago. They don't do that anymore. But the reason I picked Micron here is you've got the previous 4 earnings announcements, not so much that Q1 of 2019 one, but definitely the previous 3 had been pretty large outlier moves. So wanted to see if maybe we had an instance where the options were overpricing things a little bit relative to history. And that's what first caught my eye around this. It turns out that despite having pretty large price moves, the straddle that I came across that was actually a selling of the straddle didn't make a whole lot of sense to me. And you'll see what I mean by this as we go along here. And one of the things that I actually like to do when I do webcasts is show a couple of trades that, even if they worked out all right, maybe are somewhat nonsensical to me. And in this case, somebody came in and sold the 52.5 call and the 52.5 put and took in a credit of 380. And what they ended up with, and this was when the stock was at 52.49, they end up with this short straddle that has a break even in both directions that turns out to be smaller than the last 3 earnings announcements. And looking at something like that, it's not that when I go searching around for earnings that I'm thinking about trading, typically what I'm looking at is where I think there's a mispricing relative to history. In this case, I might actually think about doing something opposite of what this trader did, where we've had a handful of big moves and the options are still taking into account smaller moves. In fact, the break even to the upside is a little bit less than that average move of slightly over 7%. So, not a gigantic fan of this trade. There was another one with Micron that made absolutely no sense to me, and needless to say, did not work out at all. But somebody actually came in and bought a very, very wide strangle. Now, it's a very inexpensive trade, but it's a very inexpensive trade for a reason. They bought the 46.5 and the 59.5 put and call respectively, and they paid 31 cents for this trade. And unless you've got a really strong feeling that we're getting ready to get a big outlier move, and this would actually have been a move that to make money off of this trade, you would have needed a price change to the upside that was greater than anything that had happened in the last couple of years, and to the downside, in line with the biggest move, but not much greater than that. So the break evens on this trade were way out of line with respect to history. So you've really got to have some insight on what you got to feel like you've got an edge. You live across the street from the Micron factory, and nothing was shipped in the last 6 weeks of the quarter or something along those lines. But yeah, I long time ago, I was stopping at the convenience store with one of my buddies, and it was one of those times that the lotto was really, really high, and I bought a lottery ticket. And my buddy looked at me and said, "Oh, why don't you just give me $1 and I'll tell you that you lose." For this trade right here, I kind of have the same feeling around it, that just didn't make an awful lot of sense unless they were definitely hedging something out. And you can see here that after the company reported, it did move up somewhat, but did actually have a smaller move than it had over the previous 3 quarters. So neither the short straddle did okay. That long strangle just didn't work out very well at all. Of course, you put a bunch of those on and you hit a home run with one of them, then you end up having a really good earnings season. So with that, I have just because I wanted to pay attention to the slides that I have. I wanted to. I wasn't really paying attention to the questions. Thanks for the advice on trying to fix the slides. I'm more than happy to, anybody that emails me, I am more than happy to send you a PDF version of the slides. And I do apologize about the sizing issue there. I did my very best to work around that. If there are any questions right now other than how to do a better job the next time I use GoToMeeting, I'm happy to try to field them the best way that I can. And if anything else comes to mind, or you would like copies of the slides, do not hesitate to use the email address that's right there. And beyond that, if the statistics that I shared before, where it's the last what the stocks have done the last 8 quarters around earnings, I actually do tweet lists of those out when we get closer to earnings season. And I actually do it with the last 12 quarters. So that's why I put my Twitter address on there. That's just one of the things that I have done just to be somewhat helpful, because I know tracking these numbers down sometimes is a little bit difficult. So with that, I don't see any questions. Rob, do you see anything? Sometimes I miss some things.
I don't see. Oh, I see a couple questions coming through here now.
Now they come. This is actually why I kind of stall toward the end, because I think people are trying to. Yeah, I think people are trying to type while and longer expiry options. They don't have, they tend to have slightly elevated implied volatility, and that's why that's where I think you're going with this question. What about you doing longer term straddles or strangles or longer expiry options? The thing is, there is a slightly elevated implied volatility if you go out the next week. If you go a little bit farther, it does make some sense. And something on my list of things to do while I'm in quarantine is my understanding, and this comes from some academic work that I'm doing around that PhD I'm finishing up. Stocks tend to trend in the direction that their earnings reactions, in the same direction of their earnings reactions for several weeks into a quarter. So the question that you just asked about using longer expiry options, you're going to be buying options that have more time value, but they are pricing in lower implied volatility. And if you get things correct directionally, it might be something that you leave on as long as it looks like something's trending in the right direction for you. And something maybe that you could do going out, because we've got weeklies going out 5 consecutive weeks. You could do this for a 3 to 4 to 5 week trade with lower implied volatility options. And then the other part of it is, if you're wrong because the options don't have an extreme amount of implied volatility in the price, you probably can salvage the trade without the sort of loss that you would with the sort of price action that you would get out of the options that are going to expire in 2 or 3 days. So what you brought up is on my list of things to work on. I'm probably going to spend a little bit more time on it as I take a look at how the stocks that have very active options, if they actually follow that continuation of the trend after earnings for the next few weeks. And the universe of stocks that I use for all of this is the 100 stocks that have the highest option trading volume of the previous year. I reset that every year, and I just reset it for this. Don had a couple of good questions. Taking advantage of the info, it circles back to every option trade. This is one of the things that we taught when I was at SIBO. Every option trade starts out with with some sort of price and time outlook for the underlying. And around earnings, the timing is very short term. And by taking what the stock has done, historically around earnings into account, or after earnings into account, that helps you with the price outlook, as far as then taking the next step and working into what your option trade should be. That's why when I formulate these things, I actually show what has the stock done in the past, and then show a couple of examples of option trades that have occurred, that I found interesting, either because they didn't make a whole lot of sense, but they did make a lot of sense. And the higher the implied volatility doesn't necessarily mean that we're gonna get the higher move around an earnings announcement. It really is a function of what the option market's expectations are. And sometimes the option market's expectations will differ a bit from history, especially if we've gotten a big outlier move, and when I say outlier move, I mean a smaller than average move or a larger than average move over the previous couple of quarters. So yeah, the higher the implied volatility is, the higher the anticipated move around the earnings announcement. But if you feel like you've got somewhat of an outlook and the option market's not totally agreeing with that outlook, that's where you think about trading earnings. Do I have a service to offer? No, I don't. I'm not trying to sell anything whatsoever. I have a strong interest in trading around earnings. I do work for a firm called EQDerivatives, where I do some consulting with some large hedge funds and some mostly focusing on taking volatility into account with what you're doing with respect to the option market. But as I mentioned, I do tweet out the information ahead of earnings based on what's the history been for Facebook. And I put those numbers out typically late the week before earnings. Probably put the list out for the stocks that are reporting next week, Thursday, or probably Thursday this week, since Friday is a market holiday. But if you just follow me on Twitter, you can have those numbers for nothing. I'm just generous that way, I guess. I do like to get some feedback from people, and the one question that I got about the previous question about the longer expiry straddles and strangles, that's a lot of the great ideas that I've gotten that have turned into some what I think are useful webcasts often come from the feedback that I get doing things like this. So that's why I'm here right now. Where did I get the historical data from? I get the historical. I'm going to start answering the question. I'm going to make sure I'm answering I'm going to make sure I'm answering the question correctly. Where do I get the historical options data from? I basically keep up with earnings as we go through the earnings announcements, and I keep up with the large block trades that I see from day to day around earnings announcements. The historical data around the things that look like this historical information is a database that I have been tracking for almost a decade now. So I keep up with all of these numbers. And like I said, I focus on the top 100 optionable stocks as far as option volume goes. And so sometimes I actually have to go do some digging after if a new stock comes along. I can tell you that I had to go do some digging on Snapchat, Uber, and Lyft, which don't have a whole lot of history, but those were relatively new stocks when I started putting all of this together. Can earnings be deferred into the next calendar year? There are ways that companies can manipulate their earnings announcement. There are things that companies can do to, I hate to use the word manipulate, but manage earnings. There's the word that I'm looking for. And sometimes that does happen. Most analysts will pay more attention to the cash flow that is coming out of a company than actual earnings. It's much more difficult to, there's no depreciation involved in that. And it's a more straightforward figure. I can tell you that Boeing's cash flow numbers were negative long before their earnings numbers turned negative through everything that they are, that they are experiencing right now. Don was asking a Lightspeed specific question. Rob, do you see that?
Let me take a look here.
He was asking, how to take advantage of this through the Lightspeed platform. I mean, looking at what the options are pricing in, which would show up for any platform, but.
Absolutely, you can use the platform to do comparisons on the option chains and the data to view the different Greeks and the different changes in the option contracts. And
you can look at different expirations as well, like one of the questions that popped up there earlier, which can be useful to do as well. We show that the Facebook implied volatility increases and then drops. How about you buy a straddle after earnings and sell it before the next quarter's earnings? I tested this, and what ends up happening is if you're trying to do something along these lines and take advantage of the increase in implied volatility, you end up sacrificing some time value though, and they sort of offset each other. But I tried this. I tried it on a shorter time frame where I looked at buying straddles a week or two in front of earnings and then selling them the day before. And it was really and that's a great thought, but for the most part, I saw a balance between time value deteriorating, but the implied volatility increasing. So it was kind of a net wash. It wasn't a losing proposition. It wasn't a gaining proposition either. I actually looked at it more from, does it make sense to put the trade on a little bit earlier? And the implied volatility does creep up as we get closer to earnings, but you are suffering from some time decay at the same time. So it doesn't work, doesn't necessarily work as well as one would hope. If you're thinking about using different expirations, one thing that you can often do is maybe if you think we're going to get a bullish earnings report, maybe buy a longer dated option that or put on a position that takes that direction into account, and then short something and put on a way to take advantage of the volatility crush with a shorter dated option that maybe reduces the cost of that longer dated option. You can buy long term to offset the time value. Yeah, you can. I mean, again, this is something that I've tried. You can gamma scalp to gain on time and make the position delta neutral. You can do that, but if you're, basically what you're saying here is acting more like a market maker and trying to take advantage of, the higher implied volatility options. If you exit the position the day before earnings, it's very possible that you might be in a little bit better shape than an average market making type of situation where you think the options are overpriced relative to the price movements that we're going to get. I have to think that one through. You're giving me lots to work on. Thank goodness I'm quarantined. Thanks. I appreciate it. So just got a ha-ha out of that one. So we're coming up on the 45-minute standpoint. Again, if anything pops to mind a little bit later, there is my email address. I'm happy to do my very best to answer questions that come in, and the reason that I do this, I got the question, do you have a service to offer? Really, the reason I like to do this is I like to get to the question part and see what people are thinking, especially smarter traders, and that's why I was attracted to do something with Lightspeed. I think you guys are a little bit higher level than some of the other firms that are out there, and I'll leave it at that. I'm not going to say the other side of that one. All right. Well, with that, Rob, do you have any closings? Or
we'll certainly take those compliments for our traders. Okay. I think everyone. We definitely appreciate your time and presentation here, Russell. Definitely, I hope some people were able to get some valuable insight here out of it. And certainly, like Russ said, if you guys have some questions, feel free to send some emails in, and we'll pass them over to his way as well if you don't want to email him directly. And guys, just if anyone wants to view this again, it's going to be on our website within a few days, and also our YouTube channel, along with our other recorded presentations. So we thank everyone for joining us today. We thank Russell for coming, and hopefully we can schedule another one for him as well in the future. And everyone, stay safe out there. Thank you very much. Have a great night. Thank you.
Thanks a lot.